Hello and welcome to BloombergQuint. We're in conversation today with Jahangir Aziz of JP Morgan on the sidelines of the JP Morgan India Summit, the annual summit. This time, though, Jahangir joining us from the comfort of his home in New York. Jahangir, thanks so much for your time here on BloombergQuint.
Sure.
I am going to start by asking you, Jahangir, of what you make of the progression of the global recovery. I think for a while it looked like things were looking better than expected, but if you go by the market's reactions in the last few days, it seems like there are renewed fears on the virus surge and what it could do to economic activity. How do you see the events play out?
So I think, we still haven't, managed to actually break the link between opening up an economy, mobility, and infection rate. Wherever we have tried to, open up the economy, infection rates have gone up. And it looks as if everybody has thrown up their hands and said, this is a public health problem. Public health is unable to break the link. So we're going to wait till the vaccine comes, and hopefully the vaccine will do something about it. But in the meantime, I think there are obviously, we have already seen evidence of that in various parts of the world, France, Australia, etc., in the developing market world, in the emerging market world, Brazil, India obviously stands out. And the US, and not in the emerging market world, but, US stands out as where, infection rates have been going up. And there doesn't seem to be enough amount of momentum, downward momentum. And whenever there has been, this any kind of opening up of any material sense, we've seen the infection rates pop up and, lockdowns, and whether it's localized or whether it's generalized. I think Israel has a generalized lockdown. Lockdowns have come into play. So my sense is that we have an economic recovery that's taking place. But if you look at inside the economic recovery, it's the goods sector, it's the manufacturing sector that has led much of the recovery. And again, when we talk about recovery, we're talking about recovery in growth rates, but we're not really talking about recovery in levels of GDP or levels of activity. And over there, as I said, much of the recovery has been on the manufacturing sector. If you look at services sector, and this is the bigger part of it, even in countries like China and Taiwan and Korea, which was the first in, first out countries, services recovery has lagged. And my sense is that we are going to go through 2020 and 2020, where perhaps China is the only country that has a positive rate of growth, and other countries will have a recovery, but it's going to be incomplete. Most likely, even in 2021, we are probably going to end up with an incomplete recovery. And the incompleteness in the recovery is most likely going to be driven by services failing to recover rather than manufacturing. And I think this duality within the recovery process, which I don't think has received much attention, I think will come into play both in terms of defining which countries do better than others, and how this works into, for example, inflation and therefore other parts of the policy field.
Two follow-up questions, Jahangir. One, if there is a resurgence in the infection rates, do you think the response from countries would be a little less sort of stringent in terms of lockdowns this time around? At least in India, we seem to be in a mode of we've got to live with this and we've got to learn to live with this. Is that the sentiment in other parts as well? So while there may be lockdowns, they may not be as stringent as what we had seen in the past, and hence the economic implications may be marginally lower.
I think the irony of all of this, Ira, is that you're asking an economist a public health problem. It is a public health problem. Whether or not you need a lockdown, whether or not the lockdown has to be localized, whether or not the lockdown has to be in this direction or that direction, is a public health issue. You're asking the financial markets and the central bankers and the Ministry of Finances and the economists to find solutions to a public health problem. No one is. I find it astounding the lack of discussion on the weakness and the failure of the public health system worldwide. I'm not talking about just in India, but at least in other countries there is a clear discussion. It is almost as if in 2008 you would ask a public health official, "What's the solution to the subprime problem?" We don't know the solutions to what is the appropriate response to a lockdown. So if you ask me that question, I'm going to shrug my shoulders and say, yes, most probably, we are probably going to see a less intensive lockdown because, well, no one really wants to lock down the economy because the lockdown the economy has cost economies massively. In the second quarter of last year in India itself, we've had the largest drop in GDP. Only Peru is the only country that has had a bigger drop in GDP. So obviously there's going to be fear of lockdown. But it's a public health issue. And it's a public health officials and public health policy that needs to be at the forefront to break the link between infection and mobility, to respond to the infection rate, to bring down the infection rate and the death rates. And there is very, very marginal things that economic policy can do in the midst of a roaring infection to mitigate its impact.
All right, on a lighter note, Jahangir, I think we've gotten used to having economists who give us answers for everything from agriculture to industry to public health. So forgive my question.
Yeah, so by this thing, why didn't you ask the public health officials how to solve the subject?
All right. I won't ask you that then. Let me ask you something that does fall within your ambit, which is whether you're anticipating, although you may revert to the same question, but are you anticipating the need for more sort of at least fiscal support on the monetary side? I think pretty much, you're on fifth gear already. But in countries like the US, there seems to be a conversation about the need for a second or third round of fiscal stimulus.
I think all over the world, I think there is that concern that ultimately, monetary policy have limits, even though I have to admit that the Fed surprised us at the beginning of the crisis by actually breaking past the conventions of what monetary policy or what a central bank should do and not do. And I still think there is a significant role that still remains to be played by monetary authorities. And we can talk about that. But there's a significant role still left. But going back to your question on fiscal policy, I think the fiscal policy responses in different countries have been different. In the emerging market world, you have very stark examples, the usual example that I give is Brazil versus India or Brazil versus Mexico, where Mexico and India decided to go down the path of, straight and narrow and say, well, we really do not have enough space in the fiscal policy, and therefore we're not going to support the economy with large amounts of income support and spending. Whereas Brazil, where fiscal policy was critical over the last 3-4 years in bringing down inflation, in allowing the central bank over there to cut rates, and the cut rates over there have been far bigger than they have in India. The decline in inflation has been far larger than in India. Even in a country like that, where the spending cap that they had imposed in 2017 was so central, they decided that they should let go of that spending cap, and they have, moved, in fiscal deficit from 6% of GDP in 2019 to an estimated 17% of GDP this year. And I think that we have obsessed about the short-term impact that fiscal spending or income support can do to offset the impact on private demand in 2020. In the presence, and I'm going back to the previous thing, in the presence of continued infection rates, in the presence of continued lockdowns, there is very little that fiscal policy, fiscal spending, income support can do in 2020. You are not allowing people to participate in activities. What can they do? Well, the part that we are forgetting is that the income support plays a critical role in making sure whether or not the balance sheets of people, whether households or SMEs, but particularly households and SMEs, where the balance sheets of their balance sheets, how much they are damaged. There will be severe damage to balance sheets. Just because the RBI or all other central banks have extended forbearance and we are not seeing the NPLs come up, that doesn't mean NPLs haven't formed. NPLs are there. And if we go into 2021 with damaged balance sheets, and the banks look at those damaged balance sheets and say that they are going to not start lending to a very large swath of the population, because that is the right thing to do for the banks, given that, that is a very risky venture that we're going down under, especially given India's NPL legacy, recent legacy, and continued legacy actually of NPLs. I think we will find it very difficult to see a recovery in 2021. The point I'm trying to make is the following, that the path that the government of India has chosen, which is that I'm not going to use up my fiscal space because I don't have fiscal space. I'm going to keep discipline by limiting the amount of deficit increase, may have gained the Indian government couple of percentage points of GDP and lower fiscal deficit in 2020-21 fiscal year. But it has opened up the possibility that in 21-22, when the economy recovers, we might end up with seriously damaged and extensively damaged balance sheets of households and of SMEs, such that the recovery becomes even more difficult. The simple point being that how much medium-term growth are we losing by not doing the amount of fiscal support in 2020? And I think we might end up, look, the arithmetic is anyone's guess at this point, but there is a real possibility that we might be ending up damaging medium-term growth over the next 2-3 years just because we wanted to show a semblance of fiscal discipline in 2020.
Jahangir, is India an outlier in the entire EM space that you follow? I know that in terms of fiscal response and numbers, we were supposed to be the lowest, but that continues to be the case. And my second question is that there is some talk now of government support, but the balance seems to be on the infrastructure spending, public works program side. Do you see that as a better option vis-a-vis income support, or the other way around?
So let me start with the first question. I think India is probably in the middle of the group among high yielders. So if you look at the high yielders, then Indonesia, India, and Mexico fall into this category where they have been, quite miserly, to use a word, in terms of the amount of fiscal expansion that these countries have done. Brazil and South Africa, for a variety of reasons, have done much more extensive fiscal support. On your second point, I do not really even understand this problem. What infrastructure spending can you do when the country's infection rate is going up every day? Who is going to lay out that infrastructure? Where are the workers who are going to come and do the infrastructure? We haven't managed to bring down the infection rate, and we're talking about infrastructure spending as a way out. There's only one real solution to the problem, that you provide them with income support for the incomes that they've lost. And the reason you do that, again, is not because you want, 1-2 percentage points of higher consumption. What you really want is that these people go into 2021 not with a massive debt and massive debt servicing debt services that they could not do. And again, I'm putting the households and the SME particularly in that part. So I think this idea of spending yourself out by doing infrastructure spending, what infrastructure spending can you do physically? I mean, it's a genuine question. I really do not even understand. How can you do a physical question when the infection rate keeps on going up?
No, absolutely. How would you characterize the India response broadly, Jahangir?
So I think that, in a world in which every country under the sun was doubling or tripling their fiscal deficit, you could have basically been part of the pack. Nobody would have pointed a finger at you and said, you know what, you are the one that is out of the pack. This is not 2013. There are no this fragile five high-yielder economies that have loose monetary and fiscal policy, and the rest of the world are actually following fiscal and monetary discipline. So you go turn around and you punish those 5 countries. Everybody is blowing up the budget. But suppose you didn't do it now in 2020, but you do it in 2021 because you're forced to do it. Because that's the time when the recovery does not take place because of the damaged balance sheets, because of the contingent liabilities that are rising up in the banking sector as NPLs keep rising, even with the forbearance. The forbearance only buys you time, doesn't really solve the problem. And that's the time when you do it, then you stand out as the one country which is not consolidating when everybody else is consolidating. And I think that that's the arithmetic that has still puzzled me. That why show yourself up as being the steward of fiscal discipline in the year in which every country under the sun is basically saying, look, I don't have much of a choice. I have to go and increase the fiscal deficit, increase the budgetary spending, not just because I want to spend, but also because I have a very large income shock in terms of tax revenues falling. And in 2021, when the economy recovers, that's when I'll do the fiscal consolidation. That's what every country is saying. So I think that I find it, almost inexplicable. Why would you want to behave in the manner you behaved in a year in which there was enough amount of market space that was provided by the market for you to do it? I mean, think about what is Indians' household savings doing? It's basically doing nothing right now because there is nothing to spend on. There is no investment taking place. So much so that we have a current account surplus. Our saving investment balances move so badly against investment that in the private sector, that you have a saving investment, we have a surplus there, something that we haven't seen, and we shouldn't see that. So I really do not understand what was the reason as to why the Indian government had to focus so much on fiscal space in the year that they shouldn't have focused on fiscal space. And just the last bit, I would say, look at the two rating agencies. The two rating agencies, one downgraded in India, one kept the rating and gave a stable outlook. And if you look under the hood, there is no difference in the numbers of the two rating agencies except for one number. One rating agency had a higher nominal GDP in the medium term. The other one had a lower nominal GDP. The one that had the lower nominal GDP in the medium term downgraded India. The one that had a higher nominal GDP kept India's rating straight. And the difference was just 1.5 percentage points per percentage point. That's it. And I think that's where I'm troubled by the response.
Jahangir, two quick questions. One on the monetary policy response that you alluded to earlier. I'll start with the developed market central banks. You see a role for them continuing the policies or sort of expanding on them as well?
I think the Fed and the ECB at least showed their hands very early that they were not just stuck by convention, that there are certain limits to what the intervention should be. They went and intervened and they basically moved out of the skin comfort zone and started intervening in the credit market. And I think that's an important step that they had done, which the market never anticipated. And I think that really helped not just the developed market world, but it also helped the emerging market world to say that this is the time to do unconventional policies. And the emerging market world, especially the high-yield world, did a lot of unconventional policy, and will be forced to do more unconventional policies in the thing ahead. I think more or less you're probably going to see, if the need arises, much larger. We can't call it QE anymore; it's QE and CE, credit easing and quantitative easing. We're probably going to see more expansion of that taking place. The Fed did not allude to any of that stuff, but made it very clear that if the need arises, they will do it in due course. The Fed kept the 2023 inflation rate below their target, almost saying that there is no chance of any interest rate hike till 2023. So I think that you are going to continue to see this taking place. The part that I don't think you have seen so far, particularly in emerging market world, particularly in RBI, India's case, is that as the NPLs come to the surface, and this is not just in India, but also in the developed market world, which is most likely going to come to the surface somewhere in early 2021 onwards. It takes some time before a non-payment of loan actually becomes a non-performing, 3 months, 6 months time. I think what you're going to see is regulatory easing. So we have gone through the rounds of QE, and I think you're going to continue to see massive amounts of QE continuing. We have seen credit easing in the developed market world. We haven't seen that kind of credit easing in the emerging market world. And we haven't really seen that amount of regulatory easing. I think the next phase of monetary policy expansion is regulatory easing alongside credit easing in the case of emerging market countries, but regulatory easing both in emerging market as well as in developed market.
And more support to government borrowings. We started to see Indonesia, Philippines, etc., move in that direction, perhaps inevitable for the RBI.
I mean, we sort of got saved, I think. So back in March, we wrote a huge report saying that you require massive amounts of QE in emerging markets, even if the interest rate is not going to go to zero. And those were very large numbers we were talking about, 4, 5, 6 percentage points of GDP. As it transpired, the bond market behaved much better than we had initially feared. And the amount of QE most likely is not going to be very large. And the reason being that household savings surprised us on the upside, or at least excess savings surprised us on the upside. We have, U.S. household savings rate at 23%. And Indian, as I said, we don't have any, high frequency data on saving rate, but we can look at the current account. The current account is in surplus. So so that's the part that surprises us to the extent that there is so much amount of excess savings sitting with the households that that is basically going into the bond market and keeping. So I don't think you're going to see massive amounts of QE, at least not in 2020, because of this huge increase in household savings or corporate savings rate or excess savings rate, whichever you want to call it. Maybe in 2021 you might see a little bit more QE taking place, but I think that the next phase is for emerging market countries as very extensive regulatory easing on the cards.
Right. A last word, Jahangir, on inflation. Has any other part of the world seen this slightly confounding inflation behavior that India has? Granted that we still need many more months of data.
Right. So I think it is a story with there's a common thread to the story almost everywhere. And the common thread of the story is that there were disruptions that took place on the logistic and distribution side. If you think about CPI, the vegetable that you buy in the market, that vegetable is not farm gate prices. That vegetable price includes a significant portion of that is just services. Whether you want to call it, intermediation or whatever, the cost of the stores, etc. There's a lot of services element, and services sector was the one that was the worst hit. Logistics, distribution, etc. And I think that's the part of the rise of prices that we're seeing from the supply side. From the demand side, obviously, when things got completely crushed and we are seeing a recovery in demand, so there's so much more pent-up demand. This is not for India, but for other parts of the country, other parts of the emerging market world, which have seen a very, very large FX depreciation back in March and April. That is now getting the prices. But note that all of these things are temporary things. They're not going to last. What will last is the permanent damage to demand and permanent damage to the economy that this pandemic has created, and that will start dominating. And you can already see that happening. So the inflation rate in China has already crested and is starting down. We expect China to go into deflation in the fourth quarter of this year, and that continuing into the first quarter of next year. You're already seeing that happening in other parts of emerging market, including European emerging market, where you did see a very large spike in inflation, surprisingly large spike in inflation. Again, those things are stabilizing and cresting. In the case of India, Russia, probably Turkey, to some extent, Mexico, we are probably going to see inflation crest a little later, maybe October, November. It'll take some more time because the disruptions have been longer and the transmission mechanism will take more time. But I think by the first quarter of next year, you should see disinflation back in play. And all those economies that central bankers, for which we've already said, they're not going to cut anymore. That's the end of the cutting cycle. Surprisingly, in the first quarter of next year, they'll all be back.
All right. I'll leave it at that, Jahangir. Thank you so much. Appreciate your time here on BloombergQuint.
Sure. Thanks. Bye.
Thanks for watching Bloomberg.